Hey everybody, Brian Shannon here from Alphatrends.net. It's Friday, the 24th of May. We've got a long weekend coming up, and let's take a look at the markets first. Try to make some sense of where we are and where we're potentially headed. We lost a little bit of ground this week. We were down 1% in the S&P 500. Semis got hit the hardest, of course. Well, actually, oil was down a little bit further than that. So let's take a look at these charts. As I mentioned when I was just on Yahoo Finance, it felt a lot worse than it actually was, being down 1% this week. And I think that's because we saw so many gaps higher and lower. Yesterday, we gapped down. Today, we gapped up. The day before, down, and then up and down. So it's been really a messy market here this past week. If we're looking right now at a 15-minute time frame, each one of these candles represents 15 minutes. And the most important things to look at here are the week-to-date volume-weighted average price, which we came up and tagged almost perfectly today, and then the two-day volume-weighted average price that we came down, and that was our low for today. Backing it up a little bit, though, to the daily time frame, we're still below that declining 20-day moving average. And from our peak, which was about 4% ago, the volume-weighted average price off of that peak, let's make that color red and thicken it up a little bit so we can see it, that it shows money has been flowing out from that peak. And now I think in order to get back to a little more neutral or bullish, would be back above and holding above the 20, the 50, and that volume-weighted average price. For now, it's kind of interesting that the volume-weighted average price off of this peak late January is what's been holding as support last week and then again this week. And we've been talking about that more specifically on the 65-minute time frame. Here we can see that with a little bit more clarity. And this is also the previous 280-ish level. Now, what I think is most likely for this market doesn't mean I'm not going to be able to trade it either, whatever it does, but I think what's most likely is we do drift back down, break below this volume-weighted average price in the 280 level, and then come down into this area where we're testing the 200-day moving average, and just below that, the year-to-date volume-weighted average price, and the bigger level will be the volume-weighted average price from the December lows. So I think that's what your risk is defined to over the next coming weeks, and that's maybe undercut this little low by a little bit and then be able to reverse. But right now it's clear that we're in profit-taking mode on that 30-minute time frame. We continue to make lower highs and lower lows below the declining 5-day moving average, and it suggests that we be very cautious about making new purchases in the indexes. The Nasdaq lost a little bit of ground here today. I'll just delete that. That's kind of something I was outlining for subscribers yesterday, and I do this analysis every single day for subscribers and new trade ideas and individual stocks as well. But the volume weighted average price off of that January high has been support in here, and it held today. I think that next week what's most likely is that we continue, we bounce a little bit and then drop down to test the year-to-date volume-weighted average price, which is right on with that 200-day moving average. The Russell 2000 has been testing not only the year-to-date volume-weighted average price, but we broke below that, and now we've been testing and holding above the volume-weighted average price from the lows back in December. So this market has clearly been the laggard. Maybe we get a little bit of a flush below that, and then we start to see a bounce, but until that happens, we're guilty till proven innocent in the Russell 2000. We've got a declining 5-day moving average. We see a pattern of lower highs and lower lows. One level of consolidation breaks and then becomes resistance, and that's where we are right now, stair-stepping lower. Semiconductors have obviously been the biggest losing group. They are stuck below the 200-day moving average. So, you can look at potential levels of support like a 50-day moving average that didn't hold, like a year-to-date volume-weighted average price that didn't hold, or down here. This is why we look at them as potential levels of support, where we look at the market more carefully for actual evidence that buyers are gaining control. We don't have that evidence. Right now, if we take a look at the Fibonacci retracement levels, you can see that we're a little bit beyond 50% of that rally. So maybe it stabilizes in here, but right now we have to continue to be cautious in regards to the semiconductors, and of course that means the NASDAQ as well. Now, I've been talking bearish about the biotechs for the last month or so, and they have been negative. You can see that we have that pattern of lower highs and lower lows below, that's right now stuck below the declining 20-day moving average. We have a declining 50-day moving average overhead as well. If we're to get back above this level, about 105.5, let's say, and hold above that level next week, then I think you might see a little bit of squeezy action, short squeeze that is, up in towards this 50-day moving average and year-to-date VWAP. So be careful if you're short in here, that you know where your risk is. Otherwise, if it breaks back below 103-ish, I think we see an acceleration to the downside. So continue to keep a careful eye on those. The financials had been holding up the best. They did close below the 50-day moving average this week, so kind of erasing what was possibly going to be a little bit more bullish area. It's interesting to see that in Apple, you can see that we have the volume weighted average price from the January low in this case. Right now, this market is trying to hold on to that level. I think that if you're looking for a place to buy Apple, it's at a 50% retracement. It's at that volume weighted average price as well. This is where you look for the potential. So let's see what that looks like. If we look at a 30-minute time frame, what is the direction of the 5-day moving average? It's still declining. So that means we do not trust rally attempts. So let's take a look at it a little bit more carefully on a 15-minute time frame. So there's our week-to-date volume weighted average price, where we clearly lost some ground this week, and I just deleted it by accident. So let me just put that back on there. And the high that we saw today failed right at the prior little area of support earlier in the week. So the point is, this is an area of interest on the daily time frame, but for multiple time frame analysis, what we do is we use the larger time frame to say, okay, let's look for the potential idea. Then we drill down to shorter term time frames and say, is there any evidence that the buyers are actually gaining control? And the answer is a clear no in the case of Apple. Not only did we close below that week-to-date volume-weighted average price, but we closed below the volume-weighted average price of the last 2 days, meaning that it was looking like a turnaround, but even the people who bought yesterday and today, on average, are losing money. So what do we need to see for confirmation that Apple could bounce? Well, let's do this. Let's take a look at a possible scenario. Let's say we dip down below there, shake the trees a little bit, and then rally up quickly. This 5-day moving average maybe starts to look like this the next couple days. And here's what the stock action, this isn't a prediction, this is to say here's a potential scenario of how it might unfold, that we could then buy above a level of near-term resistance like this, if that 5-day moving average is rising. And then the most important part would be, where would we put our stop? Well, below this level here. This is what I would call the most recent relevant higher low, if that occurs. So buying above here with a stop under here doesn't put all that put you in a lot of risk. If you wanted a bigger, a wider stop, then perhaps below Thursday's low, if that ends up being the low, or below a low that it might make Friday if it slightly undercuts there. So it's about anticipating and using multiple time frames together to find the right ideas. I don't know if you caught my little segment on Yahoo Finance. I was talking about Walmart. Walmart, it's above all the volume weighted average price levels from all these different peaks and lows. We can just erase that. But what I was talking about is, a lot of people get trained to look at technical analysis just for patterns, and they say, well, trend lines, and isn't that an ascending triangle? Or some people will say, no, that's a cup and handle. And the point isn't just to be a monkey who recognizes patterns, but instead to say, what's the psychology? Well, let's take a couple little pieces. It gapped up. Some people chased it. Where had it come from? It had come from 93 up to 104. That is an uneducated buy. The stock pulls back and then looks like it's holding support. Then it breaks that level, a little shakeout, and from that failed move came a fast move higher, right up into this area where it had previously found supply. Well, that first pullback was at 94. Then we saw 95.5. Now we're seeing 99 is where the buyers are gaining control. What does that tell us? What's the psychology? It says, Buyers aren't waiting for 87. They're getting more aggressive. They're buying at 95. They're buying at 97. Now they're buying at 99 and providing the support for the stock. Not only that, but this prior resistance held as support. Not only that, it's a rising 50-day moving average. So put all these pieces together and say, what seems most likely? Well, we have a 20-day moving average that's flattening out, a rising 50-day moving average, and we have a band of resistance over here. So what is happening with that? Well, not only did we see higher lows, but we saw more frequent tests. In other words, the time between these tests, in this case, was, let's just call it 6 weeks, 3 weeks, and now maybe next week we test it again. It tells us not are we getting more aggressive price-wise, but time-wise, the buyers are getting impatient. That increases the likelihood for a break higher. What was this event right here a week and a half ago? Let's look at a 15-minute time frame. That event, let me just change the scalings because we don't need all of that. But that event right here on that gap, that was an earnings report. Well, we came up, the sellers took control, and then a little bit back and forth, and now we're holding above that. So what I'd like to see in Walmart would be something like this. It looks like the stock is poised to move higher. What's your time frame? If you're an investor, maybe you set your stop underneath this little shakeout low. If you're a swing trader, maybe you put it underneath this little low. If you're a day trader, maybe something else. But the point is, when you look at the weekly chart, the stock has done nothing since, for now close to a year and a half. And buyers are gaining control. It looks poised for a break higher. And then if it breaks higher, we have a higher high, and then it pulls back down, well, that's why we get out. We say we're willing to take a small risk. But if it can break higher, I think it can easily surpass this peak over here and probably go up to 115, 120. Hope that was a good little educational piece for you. Again, I do this stuff every single day for subscribers to alphatrends.net. Enjoy your long weekend. Thank you.